Welcome to another episode at Economics Design. This is a two-part series on insurance. Crypto insurance is something that's still relatively quite new in the crypto space, yet insurance is one of the oldest industries in the world today. So we're going to deep dive into the insurance industry, and we're going to split this into two parts because this is actually quite long. The first part is going to be on the economics of insurance, and the second part we're going to do a deep dive with Nexus Mutual, one of the insurance providers in the crypto space today. So let's get started with what crypto insurance is and understand a little bit more about what insurance is and how does insurance play a role in the crypto space as it continues to develop. Before I begin, I just want to share a little bit more about what economics design is about. This podcast series, specifically, is about sharing the information and the underlying foundational principles and economic principles behind all these new protocols in place. I know as we move on to mass adoption, as we get more people on board, people will start to figure out and realize that, this is not as simple as it is. There are a lot of things behind that's going on in the shadows, working behind the scenes to make all of these incentive mechanisms work. And if we want to use DLT, if we want to use blockchain, or if we want to use these tokenization incentive models to be building it as part of our architectural future for the tech stack of tomorrow, we have to understand them from a very basic fundamentals. We have to go back to first principles. We have to understand them and analyze them from a foundational perspective. So nothing here is financial advice. Everything here is really from an educational, foundational perspective to teach you how these systems are being built and to teach you what are the things that are being considered when they're building all these different systems and protocols in place. So with that, let's get started with the 5 things that we're going to be covering today. The first one is the inefficiencies in insurance. Well, in economics, right? As long as there are inefficiencies, we love them because when there are inefficiencies, there are ways to be increasing the economic value add that the system can bring by reducing the inefficiency. So we want to start there. What are the inefficiencies in the insurance space? The second is the economics of insurance, because that's the whole focus of this topic. The third is the different risks in DeFi and crypto. The fourth, we're going to look at risk-sharing model in DeFi. How does that work? Because in DeFi, it's all about distributed finance, right? How do we distribute and decentralize all these different risks available? And lastly, we're going to have a very quick snapshot on the economics of Nexus Mutual. A quick little teaser before our next week. So let's get started with inefficiencies in insurance. Insurance is one of the largest markets in the world today, in the financial market. It's part of the financial system or the financial sector, and it has, if you include all the different premiums available, like life insurance, casualty, property, all the other different kind of assets or lives that can be insured, it amounts up to over $5 trillion US. That's a lot of money. So it's a huge market. The top insurers are getting something like 100 billion in revenue per year. And online insurance or like online retail insurance is still quite new. It's only taking up $31 billion in the market share. So 31 billion out of 5 trillion, that's a very, very small slice of the pie. So it just shows that there is a huge room for growth because online insurance allows us to aggregate more data, get more information, underwrite more different types of risks, or have a better understanding of the different risks available to be providing the insurance coverage. And this is just online in general. In crypto and blockchain, which is an even smaller niche, that's another big untapped opportunity that we want to discuss today. So what are the different inefficiencies in insurance today? The first one, absolutely biggest one, is the lack of trust. Now, where does the lack of trust comes from? And it's not like, how blockchain is all about. With blockchain, we don't need to trust people. We trust the machines. We trust the smart contract. We trust the code. And then that's it. Yeah, it doesn't exactly work like that. You don't slap on a blockchain and then you resolve the problem. No. So blockchain aside, just the insurance market alone, there are a lot of problems with that because the insurer becomes the agent of the customer. So when I purchase insurance from a company, they become an agent of me because they should act in my best interest. But they also have other interests and other incentives out there. So now they have to figure out, I've got 2 opposing interests or 2 opposing incentives. I need to make the best choice. And for the insurer, they want to make the best for them. But they're also an agent of me. So technically, they should make the best choice for me. But their priorities comes first, so they don't always make the best choice for the customer. So there's some issues with trust over there. Not only that, insurers also decide how money is being managed. One of the biggest problems with the whole downfall of the AIG during the 2008 crisis was that the insurers had a lot of money, had a lot of funds, they did not invest them well enough, and people just went bankrupt because they put all their life savings there, but the entire insurance company just went bust. So that's it. There's a huge lack of trust over there because when insurers start to use their funds to prioritize their first order objective, which is their own benefit, then prioritizing people like you and me, like the customers, then this is where the whole lack of trust happens. We could use blockchain to solve it, but just adding blockchain as a technology over there, it does not work like that. Okay, there are a lot of other things to consider, which we'll dive into later. The second thing is opaque information. Insurance, I know it's a very old industry, right? But there's still a lot of information that's unknown. And that's the whole point of insurance. The whole insurance sector actually exists because there's opaque information. It's quite difficult to assess a lot of different risks, a lot of different information. And that's why we have insurance, to outsource the risk to someone else. So not only is it difficult to assess how safe the insurer is, is the insurer going to be bankrupt? Does the insurer have a lot of bad debts? How is the insurer investing money? Are they investing it wisely? Are they giving too much luxury trips to the top management? Some opaque information. But that's still, relatively okay because you can always have regulations to say you have to disclose this, that, and the other stuff. However, the real opaque information is in this thing called information asymmetry. Information asymmetry is where I have more information and you have less, or you have more information and I have less, because we have different kind of skill sets, or we have different kind of exposure to knowledge. Sure, knowledge is in abundance. You have knowledge everywhere. Just like in the crypto space right now or in the DeFi space, you have knowledge everywhere. Follow different Twitter threads, follow on Discord, on Telegram, on WhatsApp groups, on Reddit, on Facebook, on Bitcoin Talk, on all these different forums. Information is in abundance, right? But one person is not able to aggregate all the information at the same time or continuously aggregate and process the information. So there will be people who are very specialized in specific knowledge and they will have an upper hand in information. They can use this information because they have more information than you to exploit you. So then it becomes, imagine two people fighting in a tug of war. This guy has a lot more power because he drinks protein shakes and he goes to the gym all the time because that's what he does. And you're busy doing research in front of a computer every single day. So you have two different kind of strengths available and you both are fighting along the same tug of war line. And the guy with very much information, very much gym time and protein shakes is probably going to win. So this is the same concept where in information asymmetry, you have this tug of war thing and the person with more information is most probably going to win. And this is quite opaque because it's quite difficult to understand where is this person standing. At least if you have a real tug of war, you can see, okay, this person physically looks different. So maybe, we can find a better contender to be doing your tug of war with. But in insurance, you can't choose someone just like that because a lot of things are behind the information is hidden or the information is opaque. So opaque information is one of the problems. And lastly, one of the inefficiencies is the expensive overheads. You realize how insurance companies are always advertising, they are hiring a lot of people, there are a lot of insurance agents all around. Everyone is suddenly like CFA certified and CPA and all that kind of stuff. And everyone has all those acronyms on your LinkedIn. Well, the overheads in insurance is quite expensive. Of the $100 that you give in your premiums, only about 60 to 70% goes into the actual pool fund to be repaying or to be covering your costs when something happens. 30 to 40% actually goes to overheads. Stuff like marketing, stuff like admin, stuff like regulations, all these kind of very boring things which could be automated in the world today. We have machines, we have smart contracts, we have business logics that can be turned into code and automated. So this is an inefficiency that we can exploit, that we can find ways to reduce this inefficiency. Even if we could still have overheads because, sometimes for all these machines to be running, they need electricity, right? So you still need overheads, but not at a 30-40% price. That is very expensive. So these are some things that we could do. So at the end of the day, what we want to do, we don't have to remove inefficiency, because inefficiencies will always exist. As we continue to evolve, as we innovate, as we have better regulations, we're going to have different types of inefficiencies that exist. But what we could do is to reduce inefficiencies in the system. So one of the ways that we are doing right now in the real world, in the physical world, in the bank's world, in the physical brick and mortar shop, in the skyscrapers kind of world, we have rules and regulations. So this is where the government comes in to provide laws and regulations where you have to follow. So things will be like a minimum capital level, the different kind of very long and tedious governance processes, regular financial reporting, reviews, checks. So these are where third parties, which are usually trustworthy, things like the government, will say you need to follow, and then they'll be checking on behalf of the rest of us, which we don't have enough time to be checking each individual insurance information and portfolio, right? So we have all these rules and regulations in place. These are some ways to reduce inefficiency. There are other ways where we could embrace technology to be helping us in that area. And we'll look into that later. But before we go and talk a little bit more about the whole blockchain and DLT and how that's going to change the future, let's go back to our fundamentals, because the entire point of this is to always go back to fundamentals, go back to foundations, because these principles, these foundational principles, they do not change. Once we understand what these different protocols are being built on, what kind of foundations, what kind of structures they're being built on, it's a lot easier to make improvements, to find inefficiencies, and to build much better systems and much better incentive mechanisms in the future. So we're going to get started with economics of insurance. Firstly, insurance is all about risk. A reason why I don't like insurance so much in general is because to me, it feels like they're just exploiting people who are risk averse. So risk averse are people who don't really like risk. And what insurance does is that it comes in as a third party. I know you don't like risk, so I'm going to buy risk off your hands. So you pay me some money, and I'll take this uncomfortable feeling of riskiness. I'll take it out of your hands. I'll keep it for you. If anything happens, don't worry, I'm here for you. And you can rely on me because I'm taking your risk. And you just pay me some amount of money. You don't have to think about this anymore. And that's it. So, because in general, that's the kind of people who purchase who purchase insurance, then these people, because they do want to outsource the risk, they don't really like risk, then they're willing to pay a little bit more to have that taken off of their hands. And what these insurance agents do, or insurance companies do, they will aggregate all the different kind of risks. So they'll buy a lot of different risks from people. They calculate the risk to understand how much will be lost, how much can be earned, how much can be saved, how much can be reinvested, how much needs to be outsourced, and then they can do an entire business model out of it. And to me, initially, I don't like it because it feels like you're just exploiting people who are afraid of risks. But you know what? If the insurance industry has lasted for so long, it just means that the market proves that this industry or this sector is worthy enough for them to continuously exist. So insurance has a value to add. Otherwise, it wouldn't last for so long. So insurance is all about risk. How do you manage risk? How do you calculate risk? How do you outsource your risk? How do you price the different risks? Insurance is all about risk. It's a risky business. So at its core, it's all about managing risk. How do we price the risk, and how do we allocate the risk properly so that we don't, as an insurer or as a user or as a person who buys the insurance, you're not overly compensating or undercompensating. You want to price risk quite accurately as possible to the price that you're paying. And at the end of the day, what is risk? Risk is all about uncertainty. Uncertainty, things that you don't know when can happen, you don't know what will happen, you don't know if it will happen. And we want to understand this uncertainty. We call them the probability or riskiness of this uncertainty happening. And we don't like uncertainty. People just do not like uncertainty so much. And so if we can find a probability to this risk, then we find a price tag to this probability, and that is where your insurance comes in. And then you can sell it to someone who is okay with uncertainty and purchase it. So in the economics of insurance, It's what insurers, right? In the insurers, the people like AIA, AIG, AXA, and all these insurance companies, what they do, they will first calculate risk by calculating and pricing the different risks. So as I mentioned, you have a lot of these different people who are afraid of risk. And why are they afraid of risk? Could it be number one, a person with health issues, the family, the parents, the grandparents, the great grandparents are all smoking. The person itself is also smoking. The person is very unhealthy, doesn't work out, doesn't eat vegetables, very unhealthy lifestyle. And the person wants to buy insurance, health insurance. Okay, so this person knows that his individual health is at risk, and he wants to buy insurance to cover that risk. So knowing all this information, how do we price this risk? That the risk of that person who doesn't eat healthy, doesn't exercise, doesn't go out and like work out, smokes a lot, very unhealthy inside, versus a person who is like an Olympic athlete that's always eating clean, eating healthy, going to and work out, not obese at all, completely in a healthy weight, really takes care of their health. Now, these two people wants to buy insurance. The obese person, the obese unhealthy person, the risk is definitely higher, right? The probability of this person dying from a lot of health issues is a lot higher than the healthy person who takes care of the health with no bad history in the whole family records. So because the risk is different, the price is also going to be different. The price to sell them the health insurance. Because the probability of the obese, unhealthy person going to the hospital all the time because of unhealthy life choices is going to be quite high. And if the insurance company has to always pay for it, then it doesn't make sense that both of them are paying the same price, because the healthy person is probably not going to the hospital at all unless it's a very serious issue that happens once in a year or once in every few years. So the probability of these two uncertainties are quite different. The risk is quite different. So the premiums or the insurance prices is also quite different. So what does that mean? It means that we're just playing with the probabilities and then pricing it. So that's on the individual level. We call them the micro level. In the macro level, what does the insurance companies do is that they have all these different clients, right? All these different people with different health history, health benefits, or health deficits, all buying insurance together. And what they do as the insurance company is where they aggregate all the different risks, all the different health profiles of people. Then they figure out the probability of the risk happening or not happening at all. So maybe 80% of people are healthy, good family background, they take care of themselves, really conscious about health, and the probability of them needing a lot of money for a random healthcare payout is low. Whereas you have 20% of them who are smokers, who are obese, who have a lot of health issues. The family have a long history of health issues and all this kind of stuff. Then you kind of aggregate the risks together and you calculate the probability of how much you have to pay out. And that will be, kept in like a little pool so that anytime it's needed, you don't have to be looking for money everywhere. You can just use that to be paying these people that they have been paying their premiums as well. So that's in general the very basic core. Now, how do they earn money then? Because that's all about pricing risk, right? Pricing what's the probability of payouts. They earn money in two ways. Firstly, it's the premiums. So insurance is not like, do you want insurance? Raise your hand and you come in and I'll insure you. Insurance is more like, this is a theme park. And if you want to come into the theme park, you have to pay your entrance fees. And that's how it works. Before you go into the insurance theme park, you have to pay a fee. And when you take the ride, so maybe it's a hospital ride, you have to pay some fees. You have to co-pay. So maybe the insurance company pays 50%, you pay 50%. Or it could be a different kind of system where you just pay the admission to the theme park and you can take all the rides for free. So that's like full payment for the insurance, for the health insurance. Depends on the insurance package you have, depends on what country that you're from. But in general, they will take money because before you enter the theme park, you have to pay the admission fee. So we call that the premium. And the premium will be judged based on you as an individual, depending on the insurance, right? It could be a car insurance, health insurance, life insurance, business insurance, mortgage insurance, building insurance, different types of insurance. And I told you out of that 100% of money collected, they play with probabilities, right? Not all 100% will be paid out. So where does the other percent of the not paid out go? Where does it go to? That amount that is not actively used to be paying out, it will be reinvested in other areas. So that's how insurance companies, they make money. So they reinvest it in other places. So that was just the general idea of the economics of insurance companies. Now let's go into the different economic school of thoughts or economic concepts in insurance. The first one is the economics of signaling. Signaling is where we use different kind of actions to share or hint hidden information. So things would be, very common things would be like poker. Poker, by raising the cap, raising the prices, or raising your bets, you are signaling, or your action is trying to share some hidden information, something like your cards are very good. So you want to raise the bar, or you want to raise the pot, or you want to have all in. These actions are trying to share some hidden information that you know. Angel investing is another way of signaling, because if you are a startup, you go to angel investors, then you go for a seed round, and then you have round 1, round 2, round 3, or round A, round B, round C. These are different kind of signals, because those investors that put money in you initially during your first few rounds, they show that they have faith in you, that they believe that your business and your idea is good. So that's where the whole angel investing, the previous angel investors are a form of signal to the future investors, saying that my action to put money into this company is showing that I've done my due diligence to this company, and this company is probably very good. So one of these signaling things that is in the traditional financial world is the Warren Buffett halo. So basically, any company that he invests in, or the company invests in, there is just a premium to it, because his signal, so Warren Buffett's signal, is just so strong that it will increase the price or increase the valuation of the company that he invests in, or he is putting money in. The other one is also IPO. So IPO is where a company is listed on an exchange, and before IPO starts, usually they also have a lot of institutional buyers or institutional investors that are interested to be purchasing before an IPO. And that's where there is a whole mechanism behind, which is quite fascinating. And that is a lot of signaling going on behind the scenes before the IPO thing. So that's the whole economics of signal. And in the insurance space that we want to talk about, we're looking at pricing as a signal, where pricing is a way to show and share hidden information. Because in insurance, just now we talk about insurance is very opaque information, right? You can't really tell a lot of different information because all the information is hidden behind the scenes. It's all opaque. So we use pricing as a signal to be sharing what the pricing is, or what hidden information that we want to subtly bring across. We do that with pricing. The second economics principle is the economics of moral hazards. Just now, when we talk about signaling, it's about the actions to show hidden information. In moral hazards, it's the problems caused by hidden actions. So hidden information and hidden actions are different things. Hidden information is usually before the thing occurs. So before you show everything in poker, or before you show your cards, that those hidden information occurs before the event happens. Moral hazard is usually when something happens. Moral hazard is the actions after the thing happens. So this, for example, you drive a car rental and insurance. If you book a car and let's say you book a car and you have insurance for the car as well. So you're less likely to drive cautiously because you've bought insurance for the car already, and if the car is damaged, the insurance will cover for it. So that's so these are problems caused by hidden actions, moral hazards. So this is inefficient because, once again, people are not being 100% transparent, 100% truthful. In signaling, a lot of information is hidden. Maybe because you can't tell, maybe because it's difficult to tell, maybe it's just really, really unavailable, or you just can't tell, you can only show. So there's problems with transparency. In moral hazards, It's hidden actions that happens after the event has happened or after the contract is being signed, the insurance is being bought. So this is where inefficiency comes in because it's not 100% transparent again. So what we want to do, we want to increase. So with the economics of moral hazards, one of the problems is that because the burden is being shared, right? Because I bought the car insurance. If anything happens to the car, I know I have to pay, but the other guy also has, the insurance guys also have to pay. So I am okay with increasing my exposure to risk because the burden is shared anyway. So you are more likely to increase your risk exposure because the burden is being shared. Now, is this good or bad? It's quite difficult to say because on one hand, to increase risk exposure sometimes could be good in some situations. But in general, to increase risk exposure because you're not bearing the full burden because someone else will take the burden if bad things happen. That's not what we want. That's not a very efficient model because we're going to have a lot of losses. We're going to have a lot of dead weight loss. We're going to have a lot of efficiency losses. So what can we do to minimize this moral hazard issues? And in insurance, one of these is usually to do co-payment. So instead of the insurance company covers for everything, the person, the insurer and the insurance company pays together. So they share the payment. And lastly is this thing called the PA relationship, the principal-agent relationship. At the end of the day, insurance is all about this entire thing called the principal-agent relationship or the principal-agent model. You've got two parties. You've got the principal, you've got the agent. In general, remember I told you just now that the insurance are the agents of me because they have to take care of me, spend my money on my behalf properly so that when something happens to me, my insurance can cover. So principal agent is where you have two parties, a principal, like the main person, and an agent that works on behalf of the principal. And when principal agent models and principal agent relationships can be very helpful when we align all the incentives together. When one party is doing something that benefits the other party also benefits the first party, and they work together hand in hand. Incentives are aligned, and this is very good to achieve the best objective that benefits both parties. It's efficient. What happens in this situation, a bad thing that happens, is where one will be exploiting on behalf of the other. So going back to the example of the 2008 crisis, right? A lot of insurance companies failed, a lot of companies defaulted, and that's because their incentives were not aligned. For those banks, the incentives were the bank's own profits and benefit and profit margins and bonuses, and they were investing in very risky assets. And remember, we're talking about life insurance. So at the end of X years of your life, you can get some money back and until you die. So these life insurance are basically these people's entire life savings. So they are the principal, insurance are the agents that help to reinvest for these principals, right? These regular people with their life insurance in the hands of insurance agents. And these insurance agents were not tactful. They're reckless in their investment, and it resulted in bankruptcy with a lot of bad investment. And the loser in this case are the principals because they just lose all their money. So this is where incentives are not aligned and one party exploits the other. So what we want to do, we want to increase the alignment of incentives. We want both parties to be aligned together. We want both parties to be benefiting each other and working together so that it helps each other to grow. So in the crypto space, it's quite difficult to define the principal-agent relationship because we have anonymity, we have a lot of things that it's quite fluid, and there isn't regulations yet. The entire space is still experimenting and growing. However, one thing that really binds the entire crypto space and DeFi space together is smart contracts or data. With smart contract, it's easier to rely on the code to underwrite the different risks available. And so in the crypto space right now, a lot of the insurance that we see is either smart contract insurance, so something that you can absolutely verify with code, or data heavy insurance. So you can use external data, or you can just use data in general to be verifying your errors, your inefficiencies, your different compensation that needs to be done. So with crypto, we can streamline this inefficiency a bit, but we can't resolve everything, not right now. So we can do things bit by bit in small little steps. And lastly, as I mentioned, the economics of this entire insurance industry is all about numbers. It's about aggregating all the different kind of risk profiles of people, because some people are riskier, some people are risk-loving, some people are less risk-loving. You aggregate them together to find out what's the probability distribution of the different risk profiles that you have. Then you can bet on the long tail risk of these. The tail risks are basically things that wouldn't happen so often, but when they happen, it's going to be quite significant. So they will bet on these different tail risks happening, and low probability, but still possible to happen. This can only be done when you have a lot of numbers. So we call this the law of large numbers. This is used very much in statistics. And in insurance, it's all about statistics. If you're interested in the industry, you should check out actuarial science, because it's all about looking at numbers and looking at data to be pricing risk. I talked a lot about pricing risk in monetary terms. It's not exactly, I have a check box and I have this different, like the risk name starts with L. That's a good thing. Or the risk covers 3 points. Okay, that's a good thing. And then you just price the risk that way. No, there are a lot of different data and analysis that goes into it. So data is really, really important. And this is where crypto can perhaps become a small little breakthrough, because we're talking about a distributed data set that cannot be modified, that cannot be edited, that cannot be changed. So you can aggregate this trustworthy data once it's verified, and to be inputting it into your system to be calculating the risks. So that's one of the very interesting potential as the system continues to grow, as more people come in on board, and as we understand a little bit more about the risks involved and how to price them. Talking about that, what are the different risks in DeFi and crypto? Because when we talk about insurance, as I mentioned, insurance is all about risk. Insurance is all about probabilities of something happening or not happening, the probability of uncertainties. And risks are the different uncertainties that we want to be looking out for. So the example of different risks in the DeFi space or in the crypto space. The first one is the DAO hack. So that's an example that it's always being brought up. During the 2018 period, where there were a lot of ICOs booming, there was this Ethereum DAO that was created. A lot of money was being put in there, and then someone found a hack. Someone took out a lot of money out of the DAO. So the DAO is a decentralized autonomous organization. People put money in. A hacker took a lot of money out, and this is where the Ethereum Classic came, because they had a hard fork, and people either stayed on Ethereum or moved to Ethereum Classic. So they're two different Ethereum chains. So this is example of a risk, because you could hack the hard-coded smart contract, or you could hack the system. The second is the Polkadot parity multi-sig freeze. Basically, the Polkadot is a layer 1 solution as well, like Ethereum, and they collected a lot of different funds, but there was an error in the code, there was a bug in the code, and the funds were frozen. That means basically the funds are lost, and that's a lot of money that's being lost, and there's nothing they could do about it because there was a bug in the code. The other one is the Yam Finance governance token rebase contract. So if you remember a few months ago, it's been so fast. A few months ago, there was this entire hype of the Yam token. What they're doing is to include YFI plus Ampleforth, putting it together so you have a governance of YFI plus a rebasement of Ampleforth. Very interesting topic. You should check it out. And they put them together to create this Yam token. So everything went well, and then they realized, oh no, there's an issue with the governance contract. They tried to get the community together to fix it, but it could not be fixed. So that's it. That was a lot of funds were taken out of Yam. And although Yam is now at version 3, it has a lot less value locked in than when it first started. But it's okay, it was all an experiment. It was a good experiment. But this is an example of a smart contract risk. Then we have liquidation in the Maker's Vault. So on Black Thursday in March 18th, a lot of value is being wiped out in the crypto market, in the DeFi market, in the traditional financial market. a lot of value is being wiped out, and one of the things is the maker's vault. When people are minting DAI, they put the collaterals into this thing called the CDP to be minting DAI. And during this period, because everyone has this thing called margin call, lots of transactions going on. It was very expensive to send any transactions through, and a lot of people had to replenish their vaults because the prices of all the assets dropped dramatically. And because they couldn't put in the transactions on time, their vaults are being auctioned out, and someone got a lot of money for very little DAI. So basically, this is not exactly a smart contract risk per se. It could be considered as, an external kind of like infrastructure risk problems or some sort of governance issues. But these are still risks available, or these are still risks on chain, right? On the crypto platform. And lastly, you have the BZX smart contract exploit, where this person or this hacker, it's not even a hacker, it's just this person exploited the smart contract to be getting a lot of money for very little money. So these are some risks available, and these are not, some of them can be bugs in the smart contract, some of them can be exploited through malicious hackers, some of them could be kind of the governance structure, some of them could be the different the external system that has issues. So there are a lot of different risks available, and these risks are going to continue growing because as we are starting to explore the place, and there's still very little regulation, in fact almost no regulation in the crypto space itself, then the risk is quite large. So in DeFi in general, what are we looking at? In DeFi, technology is a double-edged sword. On one hand, technology is really, really good, like blockchain, is very good at coordinating all these different participants, at finding new incentives to be incentivizing different behaviors and optimizing the community. So technology is really good at that. At the same time, technology exposes a lot of inefficiencies that we have. All the inefficiencies that I talked about in traditional finance or traditional insurance, it doesn't mean that we just slap on the blockchain and these inefficiencies will be gone. In fact, by putting all these old systems on new infrastructure, new technological stacks, we are increasing the inefficiency because it becomes so quick and efficient to be inefficient. As in, all these inefficiencies that we have, they're going to be executed at a much faster speed because that's what technology and digitization is. So what we want to do is, when we understand that the power technology brings is coordination, is incentives, is collaboration, how do we use all these different mechanisms in place to reduce the risk, to reduce the inefficiencies of the other edge of the sword? Right now, we're still very much in our early days. We're still exploring, experimenting, figuring out what are the right incentives, figuring out if these incentives work, figuring out how people react to different incentives. So we're still in a very early new days. It's quite a golden time to be alive. At the same time, because we're so early, it's very risky. It's risky because the system is a lot more unknown. If you look at the traditional financial market, no matter how unknown, no matter how much of a new product it is being created in the traditional financial world, it's not completely new. You can always still find references from different areas, and you can kind of structure the pricing of risk some way, somehow. Yet in the DeFi space, a lot of things are completely new. A lot of things are very uncertain. And when you have too much uncertainty, you just can't price it. Remember, insurance is all about risk. Risk is all about uncertainties. And if something is way too uncertain, even the insurance companies are too risk averse to want to underwrite and take on this risk. That means it's so risky that even the insurance companies say that I'm not buying the risk from you because it's too risky, I'm not interested in that. Insurance companies are only interested to buy risk that is within their threshold of risk tolerance and they can make some money out of it. But if it's too risky, it's too dangerous, right? You could lose everything. And then what's the point of buying risk from someone if you're going to lose everything anyway? So at the end, what we could do right now is find out what is in the DeFi space or what is in the crypto space that it's a little bit more assuring, a little bit more secure, a little bit more concrete. And what's that? that is definitely the code, the underlying technological code or technological stack. Because at the very least, it is the thing that is coded in, that is black and white in the system. Because you could code the smart contract, you could define the smart contract, you could define the mathematical models, you could define the business logic in that code. And people are not able to change that. That's the whole point of immutability in DLT, right? And so with that code in place, with that black and white thing in place, with that structure in place, it's a lot easier to figure out the risk associated with that code. So with the code, you could look at things like there's a bug in the code, there is an error in the code, there is the business logic just doesn't flow in the code, and so there are different errors, and you could underwrite those errors because it's a little bit more structured, a little bit more obvious to be understanding the risks. So if we talk about moving the traditional insurance space to the digital platform, what is the main difference? What are the value add that we can bring? Firstly, it's a community first approach. You realize that everything in the crypto space, everything in the DeFi space is very much community focused. That means everything that is done for the community first. If the community doesn't have any adoption, there's no mass adoption, then this system just doesn't take off because the market, which is the community, decides that this adds zero economic value and I'm not using it. So we are shifting. It's a very good shift when we are moving all these systems to the blockchain platform because we're going to look at community first approach. So this is something like, a product market fit. You want to find product market fit first before you start building your beautiful pitch deck and realize that, the market actually doesn't want it. So the entire community first approach, especially in insurance, is how do you assess the different risks? How do you allocate the risk properly? How do you reward people who are willing to take on the risks? So these are community first approaches. The other thing is we're going to build something old in a new way. So something old is insurance. Insurance is a very old model. But we're going to build it on a new way because we're building it on a new technological stack. An example would be the oldest way of insurance. It goes back to a long time ago where we talk about farmers. Let's say I'm growing rice and someone else is growing corn. And in this community that we have a lot of different plots of land. Every farmer with a plot of land will put some money into this pot. And whenever one of the farms is destroyed because of bugs or because of fire or hurricane or because some person decide to light it on fire, then they can use the money from the pot to be helping and rebuilding that farm. So that's good, right? Because it's all peer-to-peer, it's distributed. That's the entire idea of insurance. And in general, that's good. And that's how insurance started. The problem is that when we're talking about, let's say, drought, a drought is not something where drought only happens in my little farm and it's okay with other people's farms. No, drought happens when it happens to everyone's farms. So not everyone wants to get a little piece of the amount of money in the pool, and that's not enough to go around, and that's not enough to save everyone. So they're not distributed enough. So this is where insurance companies come in and say, you know what? Let me be the one to buy your risk, and I will be diversifying my portfolio. So I'll be getting you insurance. I'll be giving you insurance for farmers. I'll go to the dairy farmers and give them insurance as well. I'll go to the government to give them insurance. I'll go to the schools to give them insurance. So you have different types of insurance pools. And you want to make sure that they're not cross-related. And that's how you can diversify your risk. So that's in general how it works, right? And what we could do, and these are intermediaries. Insurance companies are big intermediaries, and they aggregate the risk and they get a lot of money out of it. So what we want to do now is we want the same model of decentralized distributed insurance, but we don't want this middleman coming in to take up all the margins, to eat up a lot of these operational costs. So we could streamline that business logic. We could streamline that a little bit more with machines, with smart contracts. And that's where blockchain comes in, because blockchain could be the one doing that. And that is basically building something old in a very new way. And lastly, a big improvement would be, as I mentioned, there were like 30 to 40% of money just being lost in overheads. And one thing that could be done is that all these things can be codified, all these business logics can be codified, and we encode them in smart contracts. So this becomes a very big improvement because smart contracts, it's not going to take up 30 to 40% of your premiums. Maybe it's going to take out a couple of percent, maybe 10% maximum, with all the other management things going on around and the electricity to be running the codes. Then it gives us additional 20 to 30% to be redistributed it out to the entire community. And that's a very good thing. So let's talk a little bit more about the risk. I talked about it a bit just now. Well, let's talk a little bit more in depth. There are 3 types of risks in crypto systems: internal technical risk, external technical risks, and the economic incentive risk. The internal technical risk will be stuff like, things that can be covered. As I mentioned just now, the insurance space in DeFi world is still very new because there are a lot of things that we just have no idea how to write the risk, how to price the risk. However, internal technical risk is still possible to kind of codify and quantify. So there will be things like your smart contract and your code on solidity. Things like your different hacks available. How people hack the system. Because there's something that you can quantify and you can make a price to that risk. External technical risk is a bit more difficult. External technical risk is something a little bit more out of your control. They could still be written on code, technical, right? But it's a bit outside of the scope of your jurisdiction. Stuff like your governance attack, stuff like your Oracle failure. Things that are on-chain, but external to your primary ecosystem. So these are external technical risks. And the probability of them could be quite small as well because you've got so many different external risks. So how do you price them? What kind of risk is that? What's the probability of them happening? It's a lot of information to process. And we still have not figured that out yet. And lastly, which I think is very interesting because I would say this is one of the things that the company focuses on, which is the economics aspect of things, the design incentive of all these systems. So this is the economic incentive risks that's out there that has not been quantified yet. So things like how votes can be manipulated, things like your concentration of power, things like how does this economic incentive affect people's behaviors that affects the riskiness or the risk profile of someone else. So it's a long chain of different variables. It's quite difficult to quantify the risk and a lot of things to be considered. But this could be one of the next new area of exploration in the crypto insurance space because this economic incentive or these economic systems or mechanisms are relatively new compared to everything else that's in DeFi or everything else that's in crypto. Because right now we are using tokens as a way of incentivization to be affecting people's behaviors to make a change, to be behaving differently. So if my incentive or my mechanism can affect people's behaviors to change, surely there's a risk to that. But how do I quantify that risk? That's still up for grabs. So I would say that right now what we're looking at is collecting a lot of data when we are experimenting with these different incentive mechanisms. And maybe a couple months or a year or two down the line, we have enough information to be pricing the different risk profiles of the different incentive models. Then we can probably start considering how to insure against all these economic design risks. And that would be a very, very interesting next step. Okay, so now let's go on to the risk sharing model of DeFi. In traditional economics or in traditional insurance, you pretty much have 2 parties. The first party is the principal, like you and me, we buy insurance. Second party is the agent, which is the insurance companies, and they will assess your risk. In DeFi, we are looking at distributed. We're looking at decentralization. So we have 3 different parties. The first one is, again, people like you and me, the buyer, so the insurance cover buyer. So we buy the insurance cover and because we want to be covered, right? So it's almost like the user. Then we have the risk assessor. The risk assessor will be people who assess the risk. Is this smart contract risky enough? Or this smart contract is actually pretty safe and I'm willing to put my money in there to say that this is safe. You have your claim assessor. Claim assessor is where there's something happened, like there's a fault in the bug And the claim assessor comes in to see that, okay, this person deserves a payout or this person doesn't deserve a payout. Simple as that. So we have three parties. Now, these three parties will be working hand in hand to be distributing the risk available in this entire system. So let's see how. So once again, we can only do the internal technical risk, right? Which is the smart contract code. So this will be stuff like a bug happens and then you need to cover that insurance of like that bug. The insurance covers that bug of the smart contract code. So for example, we take this example of smart contract code. And the cover is where the buyer will buy an insurance cover. So let's say the buyer wants to insure 500 DAI. And because DAI is quite a safe system, so I just have to pay insurance of, let's say, 2 DAI. So I will pay the insurance, it goes into the pool. And if nothing happens, I just give my 2 DAI and then continue on with life. If something happens, I file for a claim. The claim will assess, okay, this smart contract, is there a problem? Is there a bug? If there's no bug, sorry, you can't get anything. If there's a bug, we could prove that there is a bug, then your claim passes, 500 DAI is returned to you. All you lost is that 2 DAI to buy insurance, but you get your 500 DAI back. And that's it. Good to go. Next. So that's the perspective of the buyer, right? Then you have the risk assessor. Risk assessor are people who decide if this smart contract is risky enough or not. So let's say it's a Lisa smart contract token or the Lisa smart contract. And someone reads it and say that, okay, you know what? I think this is safe. I will assess it as a low risk. So I'm willing to stake my NXM token. So NXM is the internal token of Nexus Mutual. I'm willing to stake NXM tokens into this pool. And that means I put my money where my mouth is. If I say that this is low risk, I put my NXM token here and then you allowed for that period to happen. Let's say the contract lasts for 80 days. 80 days happen and there's nothing happen, like no bugs and anything. I get back my NXM tokens, and for the premium paid, I get part of the premium paid as well. So just now a person paid 2 DAI into it, right? So let's say there's 2 DAI plus my NXM token. So I get my NXM token back and I get some part of the DAI back. If something happens, then I will lose my money because the money that I put in there, it will be used to be compensating the claim buyer. So that, you see, the person will get back 500 DAI, but the person only puts 2 DAI in there. So where does the 498 DAI comes from? So it comes from this risk assessor and the NXM token. So that's for the risk assessor. Now, what about the claim assessor? The claim assessor comes in when there's a claim to be assessed. That means there's a bug in the code and someone needs to come in to say, yes, there's a bug in the code, or no, there's no bug in the code. So again, to be an assessor, you have to stake your NXM tokens to evaluate. So if let's say I say, okay, I'm expert in bug fixing. So I will take my NXM token, I will stake it there, and let me evaluate the system. And when I evaluate, I realize that, and I get to choose. Yes, that this person needs a payout, or no, this person doesn't need a payout. Based on that, then everyone will be voting. And the votes will be, weighted and whatever. There's three outcomes. The first outcome is that you are part of the majority. So I think it's a 70% majority. So if 70% of people say that, yes, this person needs a payout, then, okay, you get back your tokens, and then the person will be getting a payout, the cover buyer. If you're part of the minority, and you're being truthful anyway, but you're part of the minority, your NXM tokens will be locked up for a long time, or a longer time. So it's kind of like a punishment, but you don't lose your tokens. You just lose the opportunity cost of using their tokens, but you do not lose your tokens and the value. However, if they found out that you lie, then your tokens will be burnt, confiscated, and deleted from you. So then it gives someone a disincentive to want to lie. So you have your different incentives and disincentives in all these 3 different kind of participant roles, which is very interesting. So now let's dive a little bit deeper, give you a little bit of teaser of what to expect when we talk about the economics of Nexus Mutual. So on a very high level summary, what is Nexus Mutual? Nexus Mutual is a decentralized insurance protocol that is on the Ethereum platform. And what they do is they pull the different assets together to, as you can imagine, you have your DAI, you have your Ether, you pull them together and it's governed by all the three types of users. You have the cover buyers, you have the risk assessor, and you have the claims assessor. So it's governed and created for these users and really managed by the users. So the coverage is really just the smart contract coverage, which is the internal technical risks. That will be the code, there will be smart contract hacks, there will be smart contract exploits, there will be your different bugs in the code. So for example, a payout was in the BZX exploit that happened a couple of months ago, where someone could exploit the code in the smart contract, and the risk assessor said, yes, you could pay out, or yes, this is a risk and this is a bug and this is a smart contract problem. Yes, whoever that buys the risk can get a payout, and people do get a payout. How do you get access to NXM? This is a very interesting model then, because NXM decides to go on the regulated way. So they're a UK registered mutual company, and so for anyone to be able to get the NXM token, you have to be KYC'd. So that means, you have to send your passport information, you have to send your photo and everything. Once that's done, you have to pay a small amount of membership. I think it's like 0.002 or 3 ETH. And you pay for the membership, and now you are part of a company. Like, you are part of a UK registered company, for real. And that's why KYC is so important. And because you're now part of the company, now part of a UK registered company, you're part of the board of directors, you can get access to the NXM token. So you can get access to the platform in two ways. The first one is to buy coverage. So you can get a quote in seconds. You just have to put, what kind of protocols you want to cover, how much money you want to, or how much assets you want to cover for, and duration of coverage. And then you get a quote in seconds. So that's done, and that's coverage. You can also get access to the NXM platform by purchasing the token itself. You can purchase it on the token, on the platform, and this is defined by a bonding curve. You thought that we're done with bonding curves, right? Once we move to insurance? No. I think bonding curves is going to follow us for a very long time. I'm definitely going to talk about bonding curves in the next episode. So in the NXM model, they use bonding curves in a different way. And the bonding curve is, you purchase bonding curve via the platform, and the bonding curve will define quite a lot of interesting dynamics. It's very wonderful. I will talk about it in the next episode. You can only buy NXM token if you're KYC'd by them. However, I'm sure you've heard of this thing called WNXM, right? So there's a rep NXM that is tradable on secondary markets. NXM itself is not tradable. However, rep NXM is tradable on secondary market like Uniswap. So this Uniswap is able to, in Uniswap you can trade like Ether for rep NXM, and you can speculate on the price. You can only trade rep NXM for an actual NXM via a KYC, a person who has KYC'd on the platform itself to get access to NXM, or you have to be KYC'd to be doing that. So this is a whole new, there's a secondary market for NXM that is not trading using NXM. That is also a very interesting economic model that we will talk about. So what does the NXM token do then? What are the things what is the entire purpose of NXM token if it's not traded in the secondary market? Right, because the entire purpose of the NXM token is to be traded in the primary internal economy. What it does is, with the bonding curve, it balances the token prices with the collaterals that's available. So it changes, so the NXM price is not fixed all the time. It changes based on the amount of collaterals over there. So based on the amount of collaterals, it can cover more or less insurance, or it can provide more or less coverage. So if there's a lot of collaterals, then you have more funds to be able to be covering more of these DeFi protocols, DeFi insurance. If there's less collaterals, then you just have to cover less. So if you think about it, the price of the tokens, the internal price of the token, so NXM price, not rep NXM. The NXM price is a signal to the information of how much people trust NXM and how much people are willing to use it. Remember I told you that all the way in the beginning, the insurance is about the economics of signaling? This is what I'm talking about. Because how do you share the information that people are trusting your system? You can't just go around telling people, hey, buy my stuff because people trust it. It's like, okay, talk is cheap. So what this token does is that it becomes a signal to tell other people that, hey, my price of this token has grown because people are believing and trusting in my project and my protocol. So you should also trust it because so many people are trusting it. So this is a very interesting dynamics that we're talking about here because we are taking the same concept. Remember, in economics, the foundational concepts, the foundational principles don't change. So the economics of signaling doesn't change. But how we use economics of signaling in such insurance model in a new technological stack is absolutely mind-blowing, right? Now, the token becomes a signal to how much people trust the system. The price of the token as well becomes a different kind of signal to the adoption rate of DeFi protocols. Think about it. In DeFi, it's super cool, right? In DeFi, you've got the total locked value, you have the prices of the tokens, you have this different matrix to understand the growth of DeFi. Good stuff. I like that. But to really understand how the mass population is adopting DeFi, you don't look at the total locked value because there's going to be a lot of double counting. You look at how risk averse people are. You look at the risk profile of people. If more people are purchasing insurance, then you know that they're more likely, they're probably, number one, probably making riskier investments. So it shows that they do have some faith in the system, but they're also a bit afraid of the risk, so they're buying insurance. Or number two, more people are coming into the space, and usually these are new people in the crypto space. So you want to be covered, you want your risk to be less, so you want insurance coverage, and you get coverage with Nexus Mutual. And as more people get coverage with Nexus Mutual, the price of the tokens increase. So that also means that as more people come in, more people want coverage, it means that more people are using the DeFi protocols. And that's a good sign. It's a good sign because now it's a much better matrix, a much better variable or signal to show what is the adoption rate of DeFi protocols. Because in total locked value, you could have a couple of whales, make a big purchase it there, leave it there, and that's it. And then wait for prices to go or rise and then do something else. But it's not real adoption. Real adoption rate, we look at Nexus Mutual because it's not just amount of coverage in terms of money, but also length of coverage. So that's a very interesting matrix to consider when you're looking at the adoption rate of DeFi. And lastly, how can you use the token? As much as the token is going to be a beautiful token to talk about signaling, to talk about moral hazards, to talk about law of large numbers, at the end of the day, you need to have actual use case of Nexus Mutual. So we talked about before with all the different participants, you could use it for staking, you could use it to be buying insurance coverage, you could be using it for governance kind of mechanisms. So there are real use cases for Nexus Mutual tokens, and that's why it justifies the different value according to the bonding curve with the amount of collaterals involved as well. So if you're interested, we're going to talk a little bit more about that in the next episode. But I want to kind of wrap this up by talking about the future development of insurance in general. Because this is not it. What we're talking about here is just the beginning. It's just the beginning of insurance development and development of insurance in the crypto space. And this is getting really exciting. We're probably going to start looking at other risks to cover. So right now, we're just only looking at internal technical risk, right? Your smart contract, the bugs, the code. As I mentioned, soon we're going to start looking at the different external technical risks. So your layer 1 protocol, how will it affect your layer 2 transactions? Stuff like your oracles, stuff like your governance attacks, stuff like your Byzantine attacks, stuff like your Sybil attacks. Once we can calculate these risks, once we can put a price to them, we can cover them. The other stuff will be your insurance types. Right now we're just looking at smart contract smart contract code insurance. There could be a lot of other insurance in the internal technical risk part, in the external technical risk part, in the economic incentive risk part. A lot of other insurance available. Then I'm pretty sure we're going to see a lot of development in the insurance space. Right now in insurance, we have Nexus Mutual for the peer-to-peer DeFi space. We have Ether Risk for some flight insurance thing, which I don't know if it's still working because no one's taking flights anymore. We have the IBM, Musk, and EY kind of collaboration, which is where they use it's a B2B2B kind of system, and they use blockchain as a immutable database, which is fine. But there are a lot of other ways we could look at the development in this space. So, for example, it could be using blockchain to underwrite the different risks with lower costs. So, if we start believing that blockchain is an immutable database, we can trust the data there. We can underwrite risks a lot faster. So, for example, this shipment is going from port A to port B. We have all the different risk timing. We have the profile of the ship. We have the profile of the ports. We have the profile of the goods. Then we can use smart contracts or, these kind of business logics to be writing a risk coverage just before the ship decides to leave the dock. So then it's a lot more automated and things could execute a lot faster. And if there's anything that happens, we have all these oracles that comes in, all this information that's being aggregated from the online and offline, on-chain and off-chain world coming together, interacting with each other, and then you can have a payout immediately. So there are a lot of developments in this space, and I'm really, really excited. What about development in the crypto space specifically? Or the DeFi space? Because those could be just a B2B or B2B2B or, in the institutional space. In the crypto P2P space, I would say right now, I know NFT is a big thing. NFT plus DeFi, even bigger. Now we put insurance in there. Insurance for NFTs. We talk about art pieces. These art pieces could be hacked. These art pieces could be stolen. Could we have insurance for them? Or could we, if you think about how insurance is being made, you have all these underlying insurance, right? Like AIG, AXA, AIA. And they would take some of this insurance stuff, repackage it up, and then sell it to other people. So that's what I could foresee some other people doing as well, where NXM is the underlying layer. And you have all these other parties coming in to repackage NXM into almost like an NFT, which is like a contract, like an insurance contract that can be resold or repurchased or purchased in fractions, which is also another pretty cool thing. So think of insurance agents as a new debt that sits on top of NXM. That's what I mean. And lastly, it's reinsurance. So if you've got someone sitting on top of NXM, you could also have other people sitting below NXM, which are in reinsurance in the space. And so these are a lot of new, interesting things that will come and should come very, very soon once we understand a little bit more about the risk profiles, how to price risk, and all that kind of stuff. It is really, really exciting. So that's it for this episode. In the next episode, I'll dive deeper into NXM, into understanding the economics behind NXM, the different economic incentives in place, how the tokens work, and all the other super fun details that's going to come. If you have any questions of NXM, put them below so that I can address them in the next episode. Till then, I'll see you in the next episode. And remember, if you want to get premium access, you could go to bit.ly/econsdesign. It will bring you to the Patreon page where you could have different kind of access. You could also join the community if you want to have that kind of access too. Till then, I'll see you in the next episode. Bye!